So if you look at a house, right, and it's got this pristine, fresh coat of paint, brand new landscaping,
Yeah.
your first instinct is just to assume it's completely structurally sound.
Oh, for sure. Yeah. You don't look past the curb appeal.
Right. But then if you take a closer look and, see the foundation is just infested with termites,
Hmm.
you've got this massive contradiction on your hands. I mean, you're getting completely conflicting signals about the actual health of that property, just depending on where you look.
And that is, I mean, that is the exact tension defining global financial markets today. Traders are basically looking at the fresh paint, completely ignoring the foundation, and they're just continuing to bid up the whole neighborhood.
Yeah, which is exactly why we're here. Welcome to Tech Money Madness. For our deep dive today, it's May 25, 2026, and we are unpacking a huge stack of daily market briefings, earnings reports, macroeconomic data, just to figure out why the global financial dashboard is flashing these totally contradictory signals at you.
Right, because there's a lot to process right now.
It really is. I mean, we have the S&P 500 breaking records, while all these underlying economic indicators are just screaming for caution. So let's start with the fresh paint, because, the big numbers are pretty undeniable right now.
Yeah, they really are.
The S&P 500 is riding fresh highs today. It's continuing this really aggressive upward momentum. And for those of you tracking the market structure, we saw this ending diagonal pattern sort of compress and complete back in March. And since then, I mean, the market has basically just acted like a release spring.
Yeah, and the momentum carrying that release is, it's really substantial. Because if you look at the current trajectory, the forecast suggests the S&P is looking at resistance in the maybe 7,600 to 7,700 range.
Wow, really? Up that high?
Yeah, we are just not seeing any sort of meaningful technical breakdown that would, indicate a corrective phase is imminent. And honestly, the optimism isn't even geographically isolated.
No, far from it. I mean, over in Europe, stocks just hit their highest levels since March 2nd.
Mm-hmm.
And then if you zoom out to the Asian markets, the Nikkei 225 just breached the 65,000 mark,
Yeah,
which is just this massive historic psychological milestone.
absolutely.
But, these local records don't just happen in a vacuum. So I'm looking at this Nikkei surge, and I really have to wonder how much of this is actually Japanese economic strength,
Right.
versus just a reaction to broader global inputs.
Well, if we connect this to the bigger picture, it is heavily, heavily weighted toward the latter.
Okay.
Because the Nikkei breaching 65,000 is really just a direct, real-time reflection of global commodity movements. Specifically, the sharp decline we're seeing in oil prices right now.
Oh, interesting. Because of their import reliance.
Exactly. Japan imports well over 90% of its energy. So, when global oil prices drop, the input costs for the entire Japanese manufacturing and industrial base just plummet, like almost overnight.
Right, so profit margins expand, corporate outlooks look great, and boom, the Nikkei surges. Which naturally brings us to the geopolitics driving that oil drop. Because the recent volatility we've seen in energy markets has been, well, inextricably linked to the U.S.-Iran conflict. But looking strictly at the supply chain realities for a second, the market seems to be, exhaling right now.
Yeah, they're definitely exhaling. And the primary driver of that relief is the progress we're seeing in negotiations to ensure the Strait of Hormuz remains open.
Which is huge.
Right. It's one of the world's most critical energy choke points. I mean, it handles a massive percentage of global oil transit. So when tensions rise in that specific corridor, the perceived risk of a supply disruption spikes, sending prices up.
And since the negotiations are actually progressing, it eases that specific bottleneck anxiety.
Exactly. The market is basically aggressively pricing in an uninterrupted flow of oil right now.
Okay, so cheaper energy gives international markets a breather. We're seeing expanded margins in places like Japan and Europe. But here's where we have to look at the termite damage in the foundation.
Here we go.
Because if the global markets are doing so incredibly well, why is the underlying macroeconomic data painting such a sobering picture? Especially when it comes to inflation. I mean, we got a really fascinating contrast in the data for you today.
The divergence is honestly stark.
It really is. So over in Singapore, their April core inflation numbers came in lower than expected at 1.4% against estimates of 1.7%. So they are seeing real tangible cooling over there.
Yeah, they're managing it beautifully.
Right. But meanwhile, the U.S. economy is showing distinct signs of slowing down, yet inflation here remains stubbornly sticky. So how does Singapore pull off this perfect soft landing while the U.S. is just stuck in the mud?
Well, it comes down to the fundamental mechanisms of their respective monetary policies. Singapore's central bank doesn't rely primarily on domestic interest rates the way the Federal Reserve does here.
Oh, wait, really? How do they manage it then?
They manage monetary policy through the exchange rate. So they actively manage the Singapore dollar against a basket of currencies from their major trading partners. By allowing their currency to appreciate in a targeted way, they effectively just import less inflation.
Oh, wow. So they cool prices without having to aggressively suffocate their domestic credit markets,
Exactly.
while the U.S. is stuck using the blunt instrument of the Fed funds rate.
Right, because the U.S. is dealing with, deeply entrenched service sector inflation, incredibly high consumer demand, historically speaking, and massive deficit spending. So the Fed really only has the hammer of high interest rates to try and nail down all of those completely disparate issues.
And this is exactly where the macroeconomic theory collides with everyday reality for you. I mean, if you looked at your grocery bill this week or your credit card statement, and then you saw the S&P marching towards 7,600, you were probably wondering what reality Wall Street is living in.
Oh, there is a total disconnect.
Yeah. Everyday financial anxiety is peaking. Household debt levels are at historic highs right now. So I really have to push back on the market's unbridled optimism here. How does the S&P keep climbing when the underlying consumer base is clearly so stressed?
I mean, the hard truth is that the stock market is essentially a measure of corporate profitability, not consumer happiness.
Ouch. But true?
Yeah, the S&P 500 is overwhelmingly weighted toward massive multinational corporations, and these entities have spent the last few years becoming just ruthlessly efficient.
They have so much pricing power.
Exactly. They have incredible pricing power, which means they can pass the costs of that sticky inflation directly onto the consumer to protect their own margins. But, your point about everyday anxiety brings us to the absolute most critical factor in this entire equation,
The Federal
the
Reserve.
Federal Reserve's response, yes.
Because the Fed sees the exact same sticky inflation and high consumer debt that we see, and they are not coming to the rescue.
Not at all. I mean, Fed official Christopher Waller explicitly stated that rate cuts right now would be crazy.
Which is such a strong word for a central banker to use.
It is highly unusual, totally unambiguous language. The Fed is signaling a clear willingness to maintain high rates, keeping capital expensive, just to force inflation out of the system.
Okay, so connect those dots for me then. Because if the Fed is keeping money expensive, companies can no longer rely on cheap borrowing to fuel their growth. Like that era is over. So how do these S&P companies justify their record valuations?
Through sheer operational efficiency. I mean, if you cannot borrow cheaply to grow, you have to cut costs, you have to optimize your supply chains, and you have to automate ruthlessly.
So they have to perform perfectly.
Right. The market's growth narrative is resting entirely on the ability of these corporations to perform at an incredibly high level without the crutch of low interest rates.
Which perfectly explains the massive wave of capital expenditure we're seeing in the tech sector right now. I mean, if enterprise companies need to automate and become ruthlessly efficient to survive this era of expensive money, well, they need the hardware to do it.
They absolutely do.
Let's look at today's earnings reports, because they reflect this exact pressure. Dell Technologies just reported exceptionally strong earnings today, directly riding this wave of enterprise hardware demand.
Yeah, it's a clear indicator that companies are willing to spend massive amounts of capital up front on infrastructure if it guarantees long-term operational efficiency. They're making the trade-off.
Right. And it's also worth noting, this Dell surge coincides with an 8-week win streak for the S&P as a whole. Though, interestingly enough, the healthcare sector just had its best week since November.
Oh, that is interesting.
Yeah, which historically suggests investors are maybe balancing this massive tech growth spending with some defensive positioning on the side. But look, you can't talk about tech, hardware, and capital expenditure without talking about the undisputed heavyweight, right, Nvidia.
You really can't.
But there is a profound structural shift happening in their ecosystem today that we need to unpack.
And the shift is monumental. I mean, Nvidia built its artificial intelligence dominance on its graphics processing units, the GPUs. And GPUs are incredibly powerful, but they're also general purpose.
Right.
The trend we are tracking today is a massive industry-wide migration away from those general GPUs toward application-specific integrated circuits, or ASICs.
We talk about ASICs a lot on this show. And, the simplest way I try to understand this pivot is to look at utility. So think of a traditional GPU as like a top-of-the-line multi-tool.
Okay, I like that.
Right. It can render a complex video game, it can calculate advanced physics simulations, and it can train a massive language model. It does it all. But an ASIC is like a laser scalpel.
Yeah.
It is engineered down to the atomic level to perform one specific mathematical
Yeah.
function.
Cannot do anything else.
Exactly. But it performs its specific task exponentially faster than the multi-tool ever could.
And what's fascinating here is that while the speed is important, the real driver of this transition is actually power consumption. Yeah, running a fleet of general-purpose GPUs for specific AI inference tasks is literally like using a blowtorch to light a candle. The energy required is just astronomical. An ASIC draws a fraction of the electricity to do the exact same job.
But wait, I need to stop you there because I'm looking at this Goldman Sachs report from our daily briefing, and it predicts that ASIC demand will completely match GPU demand by the year 2027.
Which is very soon.
That is essentially tomorrow in the enterprise hardware cycle. So how can massive data centers completely overhaul their fundamental infrastructure that quickly without absolutely destroying their balance sheets?
Because honestly, they cannot afford not to switch. The capital expenditure required to design and deploy custom silicon is massive. You are absolutely right about that. But the operational expenditure.
The power bill.
Exactly. The power bill required to run hundreds of thousands of traditional GPUs 24/7 is completely unsustainable at scale. So data center operators are doing the math, and they're realizing the energy savings from ASICs will pay for the infrastructure overhaul in a surprisingly short window.
Okay, so Nvidia is watching their primary customers realize that they just don't need the expensive, power-hungry multi-tools anymore. But Nvidia isn't just a hardware manufacturer, right? They're a massive software and networking ecosystem.
Yeah.
So how are they pivoting to survive this shift?
They are actively adapting by shifting their monetization strategy. Instead of fighting the migration to custom chips, Nvidia is basically positioning itself as the indispensable toll booth on the road.
A toll booth. I like that.
Yeah, they are integrating ASIC facilitation into their broader networking infrastructure and their CUDA software platform. So they're essentially telling these massive tech companies, look, go ahead and build your own custom silicon laser scalpels. That's fine.
Right, you still have to pay us.
Right. But if you want them to communicate efficiently across a massive server farm, you still need our networking switches and our software architecture.
Wow, that is a brilliant pivot. They are making sure that even if they aren't fabricating every single chip out there, they still completely own the underlying nervous system of the data center. But, this custom silicon arms race goes way beyond just NVIDIA's survival strategy. Every single major player in the global tech space is scrambling to secure their own bespoke hardware right now.
Because in an environment where interest rates are high and margins are everything, controlling your own hardware destiny is basically the ultimate competitive advantage.
Right.
Like Apple is currently working incredibly closely with Broadcom on custom silicon development. They want the chips powering their localized AI features to be perfectly seamlessly integrated with iOS without relying on off-the-shelf components.
And it is not just U.S. companies doing this. We are seeing remarkable engineering workarounds globally. Like Huawei has just announced a fundamentally new approach to chip design that significantly improves their processing capabilities.
It really does.
And the mechanics of how they are achieving this are wild, especially considering the strict U.S. export restrictions they are currently operating under.
It's honestly a masterclass in engineering adaptability because they are cut off from the most advanced extreme ultraviolet lithography machines, which is the equipment needed to print the absolute smallest, most advanced monolithic chips. They're pivoting
To what?
to advanced packaging and chiplet architecture.
Okay, break that down for me. So instead of printing one massive, perfect chip.
Right. Instead of trying to fabricate one massive cutting-edge die, they're taking several smaller, less advanced components, the chiplets, and they're stitching them together using highly complex packaging techniques.
Oh, wow. So they're combining older tech to simulate the new tech.
Basically, yeah. The combined output of these older generation chiplets, when packaged correctly, can rival the performance of current generation monolithic chips.
That's incredible.
It requires completely rethinking the physical design paradigm, but it allows them to maintain hardware advancement despite severe supply chain restrictions.
Okay, so we have Apple, Broadcom, Huawei, and basically the entire data center industry aggressively pursuing these highly specialized, power-efficient chips. Why? What is the consumer endgame here that justifies hundreds of billions of dollars in research and development?
Well, it is the localized, totally invisible integration of artificial intelligence into everyday life, and specifically the booming smart home market.
Oh, man. The projections we are looking at for that are staggering. The smart home products market is projected to explode from 169 billion US dollars in 2025 to 385 billion US dollars by 2035.
It's a massive addressable market.
Right, but why does it specifically require custom silicon?
Because of the constraints of edge computing. I mean, if your entire house, so your thermostat, your security cameras, your appliances, if they're constantly running complex AI algorithms to anticipate your needs, that processing cannot happen in a distant cloud server.
Because it would take too long.
Yeah, the latency is too high, and honestly, the privacy concerns are massive, so the processing has to happen locally on the device itself.
Edge.
Exactly. But you have to remember, a thermostat cannot house a massive power-hungry GPU with a loud cooling fan.
Right, that would be ridiculous.
It requires a chip that draws almost zero ambient power, generates minimal heat, yet possesses the specific mathematical capability to process those localized AI models instantly.
I see.
So you just cannot power a seamlessly connected, truly intelligent home without the deployment of billions of specialized ASICs. The consumer demand for invisible automation is the foundational catalyst driving this entire custom silicon arms race.
That makes perfect sense. Okay, so we've established the grand macro themes. We've looked at how sticky inflation and a stubborn Fed are forcing companies to prioritize efficiency. And we've seen how that demand for efficiency is driving a massive transition from general GPUs to bespoke ASICs.
Transforming the whole landscape.
Right, fundamentally altering the hardware landscape to prepare for a $385 billion smart home boom. But let's bring this deep dive back down to the immediate reality of today's trading session. How did the tape actually react to all of these overlapping narratives today?
The tape action was incredibly precise today. It was a day of highly targeted thematic buying and selling rather than, broad market sweeps.
Yeah, looking at the notable movers, Delivery Hero had an absolute blowout session. They closed up 10%. Tesla also managed to stay in the green, climbing 1.95%, a pretty solid volume. But when we look at the very top of the market, the absolute mega caps took a noticeable breather today. Microsoft closed down 0.5%. And Nvidia, despite that brilliant pivot strategy we just outlined, slid 1.90%.
And if you look at the trading volume, the most active stocks of the day were the exact companies at the epicenter of this hardware transition. Apple, Amazon, Microsoft, and Nvidia completely dominated the tape.
I really want to focus on that Nvidia drop for a second. We talked about how they are adapting by becoming the networking toll booth, but does a nearly 2% drop today suggest that traders are looking at that Goldman Sachs 2027 ASIC projection and maybe panicking? Are they hitting the sell button because they doubt the pivot?
It is more a reflection of the margin of error we discussed earlier. Look, in a macroeconomic environment characterized by high consumer debt, entrenched inflation, and a Federal Reserve that point-blank refuses to lower the cost of capital, there is absolutely zero margin for error for these tech giants.
Not at all.
The market has priced Nvidia for absolute perfection. So when a massive foundational pivot like the custom chip transition accelerates, even minor uncertainties about their ability to monetize that transition cause immediate intraday volatility.
Because investors are getting nervous.
Right. They're asking a very simple question. If money isn't cheap anymore, can Nvidia maintain its astronomical revenue growth while simultaneously cannibalizing its own GPU sales to support an ASIC ecosystem? That specific uncertainty is exactly what a 1.90% drop reflects.
It is the ultimate push and pull. So let's synthesize this deep dive. Today's market is just a masterclass in contradictory signals.
Yeah.
You have global indices like the Nikkei and the S&P surging on the back of easing geopolitical pressures and relentless corporate efficiency.
Yeah.
But on the flip side, you are battling the intense gravity of a slowing U.S. economy, this palpable everyday financial anxiety, and a Fed that is deliberately keeping the brakes engaged.
It is a precarious balance. And honestly, when you look at how corporations are navigating that balance, specifically this desperate global arms race for custom proprietary silicon, it leaves us with a pretty profound geopolitical question.
I think I know where you're going with this, and it really shifts the entire perspective.
I mean, think about it. If every major technology company on the planet, from Apple in the US to Huawei in China, abandons general purpose, off-the-shelf hardware and instead relies strictly on entirely bespoke, localized hardware ecosystems, what happens to the global tech supply chain?
It fractures.
Completely.
We might not just be looking at the end of the general tech company. We could actually be witnessing the preliminary stages of a digital Cold War.
Because if hardware becomes entirely proprietary and hyper-optimized for specific national or corporate ecosystems, the open, interconnected global supply chain that defined the last 20 years of technological growth simply ceases to exist.
That's a huge shift.
We could see the market fracture into completely walled-off, highly guarded hardware silos, fundamentally changing how global trade operates.
It completely redefines the barrier to entry, not just for new startups, but for sovereign nations trying to compete in the AI space. You'd have permanent monopolies. It's a fascinating and, frankly, somewhat terrifying thought to end on. The foundation of the global economy is being completely rebuilt with proprietary bricks, right while the S&P is hitting fresh highs on the freshly painted roof.
It's something everyone needs to watch closely.
Definitely. Thank you for joining us for this May 25, 2026 deep dive into the markets. Please remember to like, subscribe, and we'll see you tomorrow for more market coverage right here on Tech Money Madness. Keep your eyes on the road and absolutely keep your eyes on the foundation.